Hey everyone, you have heard it before. Just invest in the index. You can beat the market. Low fees, peace of mind. Index funds have been sold as the ultimate no brainer. But here's the twist: do we even know what's inside these indices? Indices like Sensex, Nifty add companies mainly by one metric: market capitalization and trading volume, not profitability, quality of management, sustainability of business model, earnings potential, or growth. If a stock or sector becomes a hot favorite, it rockets into the index, sometimes after only a few months of trading. Think back when tech stocks ruled the world in 2000. Stock with dizzying valuations and hype got fast tracked into the index, kicking out boring but solid names. When the party ended, these hot stocks crashed and index replaced them with the next flavor of the month. Now let's look at what Parag Parikh of Parag Parikh Mutual Fund and his team actually did to go beyond the usual index investing debate. Here's how they put it to test. They created two portfolios, one for the laggards, stock getting removed from the Sensex, and another for the newcomers, the fresh entries added to the index. Whenever a change happened, they invested rupees 10,000 each in new laggard and the new entrant stock right at the time of index shakeup. Each stock in the portfolio was held all the way till 31st December 2005. If a company was delisted before that, returns were calculated up to its last day of trading. True to life, no cherry picking. After years of shakeup, they calculated the total value of each portfolio to see once and for all. And guess who came out on the top? Across 42 cases of replacement, the laggards outperformed the newcomers 21 times, and vice versa. A 50% success rate. Now you will think it's pretty even, huh? But the money is in the performance. Look at this. If you had invested a total of rupees 4,20,000 in each strategy, by the end of 2005, laggard portfolio grows to 78,91,000. The newcomers portfolio grows to just rupees 31,66,000. That's more than double the wealth from the laggards, even with the same success rate. If you had bought these laggards, the stocks kicked out of the index and not the newcomers, you would have dramatically outperformed over the period of time. Seriously, the numbers are mind blowing. Laggards often deliver 2 to 3 times the long term returns compared to those new shiny index entries. But why? Because when everyone is buying the hot stock, its price gets bid up way beyond the fundamental value. Meanwhile, the so called losers get sold off and forgotten until quietly they stage an epic comeback. Simple takeaway: chasing the index means you are buying high, maybe too high. Index investing feels safe. If everyone is losing money, at least you are losing money together. That's a crowd psychology at the work. But investing is about growing your own wealth, not just feeling safe in the crowd. And don't be fooled. The story you hear about the low fees is true, but it won't save you if you are buying stocks at overhyped prices. So, what should you do? Look for unloved, steady companies, sometimes called laggards, that the crowd ignores. Many fund managers have consistently outperformed the index. So, instead of assuming that you can simply buy the index without effort and become wealthy, is a misnomer. So, be greedy when others are fearful, and fearful when others are greedy. If this changed how you think about index investing, hit like and subscribe. Share your thoughts below, and thanks for watching. See you next time.